And good morning once again, options traders. Well, who would have thought that time decay can be so complicated? Most of the times when you read different books or websites, they say, oh, it's pretty easy. The at-the-moneys have the highest time decay, and then it falls off from there. All you need to know is, to look at your theta and you'll see your time decay. It's an easy way to put the concepts into boxes, but unfortunately, it is far more complicated than that. I wish it were that easy. But if you're not getting the results from your investing or your options trading, it's a very good chance it's because you're not understanding all of the nuances with time decay. It can get incredibly complicated. So I like to show this little demonstration here for a couple of reasons. First, it shows the importance of education because we always think that strategies work one way or time decay works one way, when in fact it can work completely opposite under certain conditions. And so it's also going to highlight the importance that if you're not getting the results that you want from your options, a good chance it's because you're not understanding about time decay. So I'm going to post some videos in the future on different topics of why time decay is so complicated, but let me show you one that is incredibly interesting that very few people would ever suspect. And to do that, we need to go back to a topic that I've talked about before called Trumpification. And this is the idea that as you increase time or volatility, in other words, you start looking at longer dated options, that's increasing time, or if the markets just become more volatile, your out of the money options become more likely to expire in the money. And your in the money options become more likely to expire out of the money. And that means that all of your deltas move towards 50. So here's what it looks like graphically. Here we've got deltas on the vertical, we've got time to expiration on the horizontal, and right here in the center is the 50 delta. So up on top we have in the money strikes in green, down below we have the out of the money strikes in red. So what's going to happen, let's say if we have very little time to expiration, we're way down here, but we are looking at an in the money option. Well, its delta might be 90. It has a very high probability that it's going to stay in the money. So yeah, it's going to start behaving more like stock. What happens if you start looking towards longer dated options for that same strike? Well, now that delta might be 80. Increase the time some more, might fall to 70. This would also happen if volatility increases. Increase it some more, might fall to 60. Increase it some more, might go to 55. Do you see how we're starting to close in on a half? Well, we get the opposite effect for the out of the monies. So if we have a very small time to expiration for an out of the money option, yeah, its delta is going to be almost nothing. It might be 10. It's got a very high probability to expire worthless, so it's really just behaving like a lottery ticket. But if you increase the time to expiration, or if volatility hikes up, now that same strike might have a 20 delta. Increase time or volatility some more, might go to 30. And then to 40, 45. Do you see how these are starting to converge towards a half as well? So the idea of this convergence of all of these options moving towards a half is called Trumpification. And the first thing to understand is that this by itself is changing your time decay. So for the in the money options, you've got very little time decay here with a 90 delta. For the out of the monies, very little time decay. It's just a very cheap option. There's nothing to decay. But as you start increasing time and or volatility, you can see that those deltas become a half, and the at the money options have the highest time decay. So right here you can see that things start to get complicated. Your time decay will change just from the passage of time, or because you've changed the expiration dates, or because volatility is changing. But it gets even more complicated than this under extreme volatility. So as you continue to increase volatility, your deltas start to move towards a half, and it is true that all of your option prices rise. They're all going to increase from increases in volatility. But that's only true up to a point. This is where things start to get a little strange. And the reason is you have to understand a couple of other option pricing principles here. The first one is that there is a maximum price for a call option. Who would have thought? The maximum call price is the stock price. Whatever the current stock price is, that no call option could ever trade for more than that. So think about it. If the stock is currently 100, how much would you pay for any of the strikes? it would make no sense to pay 100.01 or higher for something that's worth 100. So yes, even though volatility or increasing that time to expiration will push up those option prices, it can only do it up to a limit. What's the maximum price for a put? That's the strike price. Because as the put owner, the very best that could happen is for the stock to fall to zero, therefore you can receive the strike price. So if you've got the $100 put, there would be no reason in the world to pay 100.01 for it or more. It's never ever going to be worth that. So there are some limits for the option prices, and at these maximums your call delta is going to go to 1 and your put delta is going to go to 0. And guess what that means? It means your theta falls to 0. So you go through points where as you increase time or volatility, where you are radically increasing the price of those options and also the theta. But if you go too far, it reverses and goes to 0. I told you it can get very complicated. So let's take a look at a pricing model. So for this demonstration, I'm going to set the stock price to 50 and the strike to 55. And I'm going to use 720 days to expiration. I'm really just doing that to make the vega, the volatility, more sensitive, just to reduce the number of slides to make the point. Let's make volatility 20%, and it tells us that our call is worth about 369 and the put is 870. Take a look at your deltas, 42 and 57, not counting this minus sign. Now you're going to see that they're going to start both moving towards 50 as we increase the volatility. So watch what happens. We increase now to 25. Did our option prices go up? Yes, they did. Call's 508, put is 1008. Did our deltas change? Yep, they got pushed closer to 50. This increased to 46. This is dropping. Technically it's increasing, I know, but not counting the minus sign, it's actually moving towards 50 as well. And also your theta is going to start increasing. All right, so watch what happens as we increase volatility some more. We increase to 30. Did our options rise? Yep, 647 and 1148. What happened to the deltas? 49 and 50. See how we're starting to converge on that? That's the Trumpification effect. And our theta's also continuing to rise because the at the monies, delta of a half, have the highest thetas. But this is only true under what we might call normal conditions. If you keep pushing the limits, let's say increasing to 50%, our option prices continue to rise, but look at our deltas. See, now the call option has shot through 50, we're at 58, and the put has dropped below 50, it's at 41. And our thetas you're going to find will eventually start to drop. Okay, so watch what happens if we go to 100 volatility. Option prices continue to rise. Look at your deltas now, 73 on the calls, 26 on the puts. And look at your thetas, still continuing to rise. But again, that's only going to be up to a point. Increase the volatility some more. We go to 200 volatility, option prices rise. Look at your deltas now, 91 on the call and only 8 on the put. Look at your thetas now, starting to drop just a little bit. We were at 0.0159, now we're at 0.0152. Increase volatility some more, let's jack it up to 300%. Call option goes to 48, put is to 53. Look at your delta now, it's at 98. Put delta, just under 2. See, they don't stop at 50. That's kind of under normal conditions. But when you get into extreme volatility, things start to change. And what you're going to find is that no matter how high you increase this volatility, this call option can never get past 50, the stock price, and this put price over here can never get past 55, the strike price. So watch, we'll try to jam the model here. We'll put in 700% volatility and we max out. Call price of 50, put price of 55, look at your deltas. 1 and 0, and there's your theta at 0. So do you see how we went through a period of increasing theta, and if you keep increasing the volatility, it actually starts to decline? Who would have thought? So here's what it looked like graphically. Here's the volatility on the horizontal. These are just the call prices. Yeah, your call prices increase a lot as we increase volatility, And that means your theta is increasing, but then you get to a point where you start to flatten out because you're behaving like stock, and your volatility is now going to flip. It's going to start moving in the opposite direction. So here's what your theta looks like. Starting to increase, you hit a certain point, and then it starts to flip and actually starts to decrease. So you can see, even in this example here, under this pricing model, at 130 volatility, we started to decline. And we have seen far bigger than that, at least on individual stocks, during coronavirus. We've seen some of these stocks at 150, 200% volatility and more. And yet traders are thinking in their head that this extrinsic value and this time decay must be going through the roof, and therefore I need to be shutting my position down, when it's actually doing the opposite. So again, the thing to understand is that there are a lot of complexities, really, with option strategies, but especially with time decay. And you cannot master any strategy without understanding time decay. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.